we've seen just in the last week in Shanghai, their vaults grew by almost 53,000 kilograms of silver in the last week. Total holdings are now up to almost 1.75 million kilograms. So you have 10% year-over-year increase in China's silver imports. So it's not just gold, it's silver as well. And it's not just the US, it's not just Europe, it's China, it's India, it's Russia. There is a massive drive away from promises and into things that are tangible in your possession. And Germany is a good example of that. But if you look at, you can see this everywhere. This is something that people should really try and understand. What Trump is doing here is eroding confidence.
Silver's impressive performance in the first quarter of 2025 has caught the attention of analysts and market veterans alike. Closing at $34.09 an ounce, its highest quarterly close since 2011, silver rose nearly 18% as a combination of industrial demand, supply constraints, and geopolitical shifts pushed the metal higher. According to precious metals expert Andy Schectman, silver's rally is not just about inflation hedging or monetary policy. It's increasingly being driven by structural shortages. Schectman emphasizes the surge in solar panel demand and the flatlining of mine supply as key indicators that silver is entering a new, more aggressive bull phase. The recent diversion of silver from London to Comex to avoid potential tariffs only strengthens the argument that the market is preparing for a significant move. One of the clearest signs of tightening market conditions is the sharp increase in silver lease rates, which have remained well above historical averages in early 2025. Andy Schectman has repeatedly pointed to these lease rates and the concurrent buildup in Comex inventories as a warning sign that physical silver is becoming harder to source. While Comex warehouses now hold record amounts, the situation in London tells a different story. The LBMA vaults have seen a historic drain, with a staggering 105 million ounces withdrawn in just the first 2 months of the year, the largest recorded over such a short period. Schectman argues that this drawdown reflects deeper issues in supply chain reliability and hints at what he calls a looming silver squeeze that could catch unprepared investors off guard. The United States, responsible for around 20% of global industrial silver demand, remains particularly vulnerable to these shifts. Andy Schectman warns that with demand rising in sectors like electronics and solar technology, any disruption to the silver supply chain, such as trade tariffs or geopolitical tensions, could quickly escalate prices. As mine production has remained stagnant for over a decade, and with global inventories being rapidly depleted, Schectman believes we're entering a period where physical silver availability will dictate pricing far more than futures markets or investor sentiment. We present the clips of Andy's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
They repatriated, they tried to get their gold back in 2013, and it took until 2017 before the gold was actually sent back from the US vaults, but the bars that they had sent back had different serial numbers on them. And so the bars weren't the same ones that they sent, which caused a whole lot of concern that those bars they had done something with those bars, and took them 4 years to come up with bars to send back to Germany. What does that really say about custodianship? I mean, it's supposed to be the bars that were put in there, the bars that are returned. So I think it is a very big deal, 100% so. But it's not just about gold, too. I mean, it is silver as well. China is a good example. We've seen just in the last week in Shanghai, their vaults grew by almost 53,000 kilograms of silver in the last week. Their total holdings are now up to almost 1.75 million kilograms. So you have 10% year-over-year increase in China's silver imports. So it's not just gold, it's silver as well. And it's not just the US, it's not just Europe, it's China, it's India, it's Russia. There is a massive drive away from promises into things that are tangible in your possession. And Germany is a good example of that. But if you look at, you can see this everywhere. I think that this is something that people should really try and understand. What Trump is doing here is eroding confidence. Now, I'm all for him and what he's trying to do, but he is eroding confidence on many levels by many of the players that will start to say, you know what, maybe we need to rethink whether it be the United States or anyone holding our assets, we'd like them in our own possession. And that's kind of what you're seeing, this weaponization of money through sanctions, through asset freezes, or any politicized financial tool like a tariff. These are backfiring as far as I'm concerned as trust is collapsing. So, the question is, are these diplomatic acts or are these signs of desperation? I don't know, but certainly something to keep an eye on for sure. What you're basically seeing is that sovereignty begins with no counterparty risk. And that's really what this all boils down to, is that you can think you have sovereignty, but if your positions are filled with counterparty risk, how sound is that sovereignty? So I think that's kind of what it's coming down to. And his actions, whether they be benefiting the American public or not, that's, I'll leave that up for debate. What I will say is that a good portion of the world believes that it's not. And so you're seeing, that's why I say, is this the act, or is the world viewing this as the act of desperation of a declining empire? I don't know. Are they? Kind of feels that way when you look at the pushback that you're seeing, especially here in Europe. They're very angry. This is just beginning. See, this is the first day that the tariffs were announced. Talk about gold at all-time highs yesterday at above 31.50, and here we are today with all this volatility at 31.10 or so. Yet there's eerie quiet in the market. There's no headlines. There's no retail euphoria. Quite to the contrary. This is not a bubble at all. This has been stealth accumulation. And the funny thing is, to your audience and to you and I, well, what do you mean stealth? Central banks are gobbling it up, right? And all the big money is standing for delivery. But take a step back from YouTube and try and find that. Watch Fox and, spending a few days in Rome last week, I was stuck with the only American speaking channel was CNBC. I wanted to pull the hair out of my head, but I watched it for a while. And I mean, you wouldn't know that gold even had a heartbeat as it's continuing to rise and rise and rise and rise. And so it's very interesting when, people are wondering, is 3,100 the top? Some analysts calling it top. Well, you got banks right now talking about 4,500, and including some very large banks like Bank of America and Goldman Sachs. So, how are we near the end, or is it just beginning based upon the lack of retail involvement, the lack of no headlines on the media? This isn't a bubble at all. So yeah, I think this is a natural pullback. It's gone straight up. It needed to exhale a little bit. Certainly did, but yet you can see a market that was down $80 this morning has roared back 50. In fact, it was up positive at one point about an hour ago. So it's volatile still, but here we are, and not even down 1% in gold after an $80 decline earlier in the morning. Crazy times, to say the least.
Gold has surpassed $3,100 per ounce for the first time, continuing its historic bull market following a period of healthy consolidation in late 2024. As the Trump trades have faded, investors' focus is shifting to the risks facing U.S. growth and rising economic uncertainty. Global financial markets are in a period of flux as Trump's tariffs, coupled with tense geopolitics and growing economic imbalances, prompt investors to seek diversification and value. The resilience of gold's bull market highlights the deep pool of buyers globally, from central banks and institutional investors to high net worth and retail buyers. A particularly striking development, according to Andy Schectman, is the large-scale movement of physical gold from London vaults to New York's Comex, with substantial amounts being taken off the exchanges for physical delivery. This movement of gold reflects a growing demand among institutional players to eliminate counterparty risk, a trend that Schectman suggests is linked to rising concerns over the reliability of Western financial systems. The influx of gold out of Comex is being driven by significant players, possibly even foreign governments, seeking to protect their assets from potential market turmoil. Countries like Germany have already voiced concerns about the security of their gold reserves held in U.S. vaults, underscoring the intensifying skepticism around Western custodianship. This shift in gold demand is more than just a market reaction. It signifies a profound change in global financial strategies, as nations and investors turn to the yellow metal as a safeguard against an increasingly unstable financial system.
Let's not forget, in the case of the gold-silver ratio, that the market can stay irrational longer than we can all stay solvent. And that's really very true. Today is a good example. I mean, the market has been unbelievably volatile today. Gold was down $80 at one point, and about an hour ago it was actually up for the day, and now it's down about $27. So, when you talk about this whipsawing, yet only giving back less than 1% on gold isn't the case right now with silver, which is down $2 to right at $32 or just above. Certainly and I guess if I had to summarize it, to me, it's almost like there's a clear effort to flush the managed money out of their long silver positions on Comex, and maybe it's to allow these commercial banks to cover at lower prices. I don't know, but certainly today was one heck of a volatile day, not just for precious metals. I mean, look at the markets themselves. The Russell 2000 index officially has entered bear market territory for the first time since 2022, and NASDAQ down almost 6%. And, the markets are getting clubbed. And then you have Secretary Besant saying, that the collapse of the market is not a MAGA problem, it's the MAG 7 problem. And we talked about last week on your show that the MAG 7, when you talk about the hedge funds having their lowest allocation to the MAG 7 in over 2 years, things are certainly starting to get very interesting, as they say, which of course is the Chinese curse. When you live in interesting times, these are not for the faint of heart, for sure. Let's not forget about the dollar, which has lost 35% of its purchasing power against gold in less than a year. And so it's not just the volatility we see in silver, but the volatility in the dollar too. And that's the thing people need to remember, is that we're valuing everything against dollars, but gold's rise of 35% just since the beginning of the year would signal that the dollar has lost 35% of its value against gold in the last year. And now you have the Fed pricing in a 70% chance of rate cuts in June, and the yield on the 10-year falling. Again, you're looking at the potential of dollar weakness going even further and further and further. So, I mean, you make a very valid point, but I would also add to that this fiat system, as you mentioned, is beginning to show cracks. And it's this global confidence that's underpinning the dollar's dominance seems to be wavering a bit, especially with what Trump is doing with the tariffs and what the markets are saying. And when you see the Russell 2000, which is the broadest measure basically of the economy, all the small caps, the businesses getting hammered, I think it's time to buckle up a little bit. I'm not making a statement on where I think gold and silver are going, but I'm just simply saying that the markets are telling you right here and right now that they're concerned about what's going to happen the rest of the year. We don't really. I mean, there have been articles, Bloomberg in particular today, I guess it would be today or yesterday, I'm not sure based upon being in Europe, but I read an article that I read today on Bloomberg that, more or less said, well, now that Trump said gold would not be tariffed, as we have said a million times, is that they're not going to tariff gold and silver. That was a ruse. That, you saw the price fall off, and now you're going to see the exchange for physical. All of this stuff is gonna revert, and metal's gonna flow back to London. I don't believe that to be the case. Look, we've seen over 15 million ounces stand for delivery on Comex this year, and it seems to be driven by some form of a whale. I mean, who the heck's got that kind of money? Who's got that kind of firepower? Question is it a foreign government? Who the hell is seeking physical delivery? And again, it's the rising distrust in the U.S. financial stability. I don't think this is going to end. At the same time, there was just an article coming up that says Germany, again, is now very, very concerned about keeping gold in U.S. vaults. They're concerned over the Western custodianship. I don't think that we will see the metal flow back to Europe, and I don't know that we're really going to figure out what this is all about until we figure it out. There haven't been any any clues really given other than we're supposed to believe it's all about tariffs, which I don't believe. That's what Bloomberg wants us to believe. I don't believe that it is. I think it's more along the lines of removing counterparty risk, and whether it be Germany removing the counterparty risk or the U.S. removing counterparty risk, reshoring, holding it in your hands. I think that's really what it's coming down to. It's about having it in your hands. It's the old saying: if you don't own it, if you don't hold it, you don't own it. Maybe that's really what it's all about. And no more paper trusts. I want it in my possession.
The surge in gold prices and the large-scale movement of physical gold out of Western vaults are indicative of significant shifts in global financial dynamics. As investors increasingly turn to gold as a hedge against rising economic uncertainty, the underlying trust in the stability of traditional financial systems, particularly those in the U.S., is eroding. This trend is likely to have far-reaching implications, not only for the precious metals market, but also for global finance as a whole. With large institutional investors and even foreign governments taking delivery of physical gold, the shift signals a desire for greater security and a reduction in counterparty risk. This action, in turn, could lead to tighter supply in the physical gold market, further driving up prices and reinforcing gold's status as a safe haven asset. That's it for today. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.